It's Amphyfx here. So today I'm going to be talking about the forex terms you must know. Now, these are the terms you have to be familiar with, especially as a beginner trader. You mostly hear traders talking about these things, or you may come across them, so you need to know them. So it's better you should watch this video till the end. Now, so the pips and points. Now, a pip is usually the fourth decimal place. The fourth decimal place in most currency pairs. For example, let's say you have a currency pair that is 1.2345. If it moves from this 1.2345 to 1.2346, if you subtract the difference, you have 1. So that's a movement of what? Of 1 pips. Now, a point, and a point is what? Is the fifth decimal place. We also refer to these as a pipette. Let's say price move from 1.2345 to 1.23452. The difference between the two will give you what? Will give you 1 point or 1 pipette. That's for pips. Pips is just the movement of the price. Now, a spread, the difference between the bid and ask price. It can widen during high volatility, especially during news. Now, let's say, for example, we have GBP USD. The spread is the difference between the bid price and the ask price. The bid price is what the buyer is asking you to pay, and the ask price is what you're asking someone that is buying from you to pay. So that's just that. If you subtract the difference between them, it will give you 2 pips. So 2 pips is equivalent to what? That's your spread. Mostly your broker charge you in terms of spread or commission. So you have to be careful the broker you use. Know how much spread they're having or how much they are charging you based on your trade. And then we have leverage and margin. Now, leverage is borrowing money from the broker to trade bigger positions, whereas margin is the money you put up to open a trade. Now, leverage is just like the money your broker borrow you, because from the onset, we normal individual traders, we cannot participate in the markets. But then our brokers came in as an intermediary. They were like, no, we should allow individual traders to trade too. They said, okay, we can borrow you money. Let's say, for example, your broker decided to borrow you $100. You now fund this account with $1. Now, for every trade you take on that $1, it is equivalent to what? $100. Because that your $1 cannot participate in a very huge market. The market, as I said, is very big. About $7.7 trillion is being traded every single day in the forex market. So you can't trade with your $1 unless your broker leverage your account. That's what we call leverage. So that's why you and I can now participate in the markets because of our brokers, thanks to them. So you should also take note that high leverage is also equivalent to what? Higher risk of blowing your account. So the higher your leverage, the more you are prone to blow your account, especially if you don't know what you're doing in the market. Now, lot size. We have 4 types of lot size. We have the standard lot, which is equivalent to 100 units of what you're buying. We have the mini lot, which is equivalent to what? 10,000 units of what you're buying. We have the micro lots, which is equivalent to what? 1,000 units of what you're buying. And the nano lots, which is equivalent to what? 100 units of what you're buying. Now, the nano lots is usually not common. The only common ones are the standard lots, the mini lots, and the micro lots. And then we have the stop loss and the take profit. A stop loss is an order to automatically close your position in case the market didn't go as planned. It helps minimizes your loss. So before you enter any position, you should calculate your stop loss. Know how much you are risking and know how much you are winning. Now, a take profit is an order to close you in profit when market hits your target. It automatically closes you out of the position and secure your profits. Now we have other types. We have market order. They execute immediately at the current price. And we have limit order. They execute only at a better price. Either you buy lower or you sell higher. Then we have stop order. It triggers when price reaches a certain level. And then we have liquidity and slippage. Liquidity is how easily an asset can be bought or sold. Now it means how liquid is market. Like is there the buyers and the sellers? Liquidity is just like the flow of money in the market. So how easy is it to buy and sell in the market? That's liquidity. And then we have slippage, the difference between expected and actual execution price. That's the slippage. If you subtract these two, you get your what? Your slippage. We have swap and rollover fees. A swap fee is the interest paid or earned for holding a trade overnight. You pay this swap fee to your broker for holding a position overnight. That's what we call what? A swap fee. Then we have drawdown. Drawdown is the percentage decline from peak balance to lowest balance before recovering. Now, drawdown is mostly like what you lose before regaining your profit. That's a drawdown, just like drawdown. Then we have risk to reward ratio. Now a 3:1 risk to reward ratio means risking $1 to make what? To make $3. If you risk $1, you should expect to what? To make $3. That's what? Risk to reward ratio. And it's highly advisable for you to stick to a particular risk to reward to remain profitable in the long run. Now this risk to reward is very, very important, and it's part of what we call what? Part of what we call is what we call risk management. So it's part of what we call risk management. You need to know this very well to stay profitable in the financial market. So guys, we've come to the end of the video. Please don't forget to subscribe, like and share this video. I'm Amphyfx. I'll see you in my next video. Peace out.